Hello, everyone. Welcome back to another SENB Daily Brief. If it feels like we just did this, you're not imagining things. Bitcoin just printed its lowest price since the election. Liquidations are back on the menu, and somewhere in Washington, adults are arguing about stablecoins like they just discovered Excel. This isn't panic, this is pressure. Markets aren't breaking, they're being stress tested. Weak leverage is getting rinsed, strong narratives are diverging, and the gap between real builders and vibes-only traders has never been wider. Some projects are bleeding, some are quietly outperforming Bitcoin in a bear tape, and miners? Well, miners are discovering that math does not care about hope. So today, we're going to slow this down, cut through the noise, and separate what feels bad from what actually matters. Because this market isn't ending, it's sorting. Let's get into it.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, let's take a look at the board. Bitcoin spent the overnight session doing exactly what stressed markets do, testing patience. BTC briefly slid below 73,000, printing its lowest level since the election before clawing back into the low 70,000s. As of this recording, we're hovering around the 72 to 73 range, not crashing, but very clearly not bouncing with conviction either. This wasn't a crypto-only move. Equities were under pressure again, led by tech, and crypto followed right along, still correlated, still treated as risk, still reacting to macro before narratives. Volume picked up across the board, but not in a way that suggests confident buying. This is reactive flow, defensive flow, positioning flow, not new money coming in flow. Ethereum didn't escape the damage. ETT traded down into the low 2100s, with some exchanges briefly dipping lower before stabilizing. It's underperforming Bitcoin again, a theme we've seen consistently during stress periods, as leverage gets pulled and risk moves up the quality curve. Solana took another hit as well, falling back into the low 90s. Despite strong ecosystem activity, price is still telling us the same story. Liquidity is being rationed, and traders are choosing survival over speculation. XRP also rolled over, sliding back toward the mid-150 range. Even narratives with regulatory tailwinds are not immune when the tape turns defensive. Now zooming out for a moment. Bitcoin dominance ticked higher again, pushing toward the upper 58 to 59% range. That's not an accident. That's capital consolidating into perceived safety, or at least the least risky option in a risky asset class. Altcoin season, once again, has been postponed indefinitely. The Fear and Greed Index, still buried in extreme fear, 14. That's not nervous. That's people are checking their apps less often territory. Historically, these are conditions where bottoms form, not necessarily where they're confirmed, but where the market starts quietly transferring risk from emotional hands to patient ones. And finally, a note on structure. This market is not cascading. It's grinding. No single panic wick, no mass capitulation candle. Instead, we're seeing layered pressure, macro, leverage, policy uncertainty, and selective strength or fundamentals actually exist. That tells us something important. This isn't a wipeout phase. It's a sorting phase. With that context, let's move into our first story. Because Bitcoin didn't just drift lower today. It crossed a psychological line, and the reaction tells us a lot about what kind of market this really is. We'll get into all of it next.
Some mornings start quiet. No rush, no noise. Just good people and the decision to roll forward.
All right, welcome back. Our first story today is the one everyone saw, felt, and immediately pretended they were totally prepared for. Bitcoin just slid to its lowest level since the election, briefly dipping below $73,000, and in the process, erasing nearly all of the post-Trump victory gains. So let's slow this down and break it apart. What happened here wasn't random. Bitcoin fell sharply into the 72.9 range, marking the deepest drawdown of 2026 so far. This wasn't a gentle correction. It was a fast, liquidity-driven move that punished late leverage and nervous positioning. At the lows, Bitcoin was down 6 to 7% on the day and roughly 30% off its all-time highs depending on which peak you measure. This was not crypto doing crypto things. This was crypto reacting to a broader risk-off event. So who got hit? Pretty much everyone. Retail traders, over-leveraged speculators, and yes, institutions as well. High-profile whales like the so-called Machi brother were fully liquidated, and on-chain data shows that roughly 44% of Bitcoin's circulating supply is now technically underwater. That doesn't mean those holders are selling, but it does mean psychological pressure is very real. Where did this happen? Everywhere. Binance and Coinbase led the volume, with Asia sessions amplifying the downside, especially markets with higher leverage tolerance like South Korea. New York trading hours finished the job as U.S. equities rolled over and crypto followed right along. Now let's talk about why this actually happened, because this wasn't about one headline. This was a perfect storm. Tech stocks rolled over hard, especially AI and software names, after renewed doubts around earnings and spending. Microsoft's Azure commentary didn't help sentiment, and once equities cracked, crypto amplified the move. Layer on top, tariff rhetoric, geopolitical noise, and thin liquidity. Algorithms did the rest. Stops triggered, margin calls fired, liquidations cascaded. Roughly $740 million in crypto leverage was wiped in short order, and that turned a dip into a slide. Hope, it turns out, is not a valid risk management strategy. So where does this leave us? Short term, volatility is not done. Options markets are still heavily skewed toward downside protection, with meaningful open interest below 70,000. That tells us traders are not yet convinced this move is finished. However, and this matters, on-chain data shows something interesting. Large holders, addresses holding over 1,000 Bitcoin, have quietly increased. RSI levels are deeply oversold, hovering in the mid-20s. Historically, these are conditions where relief rallies begin. Not guarantees, but probabilities. If macro pressure eases, even slightly, a move back toward 80 to 85,000 is very plausible. If it doesn't, 70,000 becomes the next psychological test. And here's the key takeaway. Bitcoin didn't break. It repriced. It reacted exactly the way a risk asset reacts when liquidity tightens and confidence thins. The real story isn't the price. It's what happens after the fear. And speaking of fear, when we come back, we're going to talk about the second wave, because price drops are one thing, but forced liquidations, that's where markets actually reset. Stay with us.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
Welcome back, everyone. Now, if the Bitcoin drop we just talked about was the spark, this was the wildfire. Because after price broke, leverage didn't just unwind, it detonated. In the last 24 hours alone, more than $680 million in crypto positions were forcibly liquidated. And that's not an isolated number. This was the continuation of a multi-day flush that has now erased between $1.7 and $2.5 billion in leveraged exposure. So let's break this down. Who got hit? A lot of people, and almost all of them were long. Between 270,000 and 330,000 traders were wiped out, mostly retail participants running leverage on platforms like Binance, Bybit, and OKX. High-profile whales weren't immune either. The same Machi brother we mentioned earlier was liquidated again, this time north of $120 million, proving that leverage does not care how famous your wallet is. What exactly happened? This wasn't panic selling. This was mechanical selling. Roughly 95% of liquidations were long positions, meaning traders weren't reacting emotionally, they were getting margin called. Ethereum led the pain, with over $960 million wiped. Bitcoin followed, with roughly $679 million. Solana added another $160+ million for good measure. By the end of it, total crypto market capitalization briefly dipped to about $2.48 trillion, the lowest level we've seen in months. Hope was removed from the system by force. When did this peak? The worst of the chaos hit between January 29th and January 31st, a weekend liquidity trap that culminated in over $2.5 billion liquidated on Saturday alone. By February 1st and 2nd, daily totals cooled slightly, but even now, we're still seeing roughly $500 million in forced closures per day. That's not stabilization, that's damage control. Where did this happen? Primarily on centralized exchanges. Asia handled the bulk of volume. Binance and Bybit processing over 60% of liquidation flow, with South Korea's leverage-heavy culture and VPN-driven China trades magnifying the impact. Institutional flows ran through Coinbase in the U.S., where ETF hedging and basis trades quietly absorbed volatility. This wasn't retail versus institutions. It was leverage versus math. So why did this get so violent? Because leverage was stacked on top of uncertainty. Traders were already stretched, 5, 10, even 100 times leverage, when macro pressure hit all at once. Fed chair speculation leaned hawkish. Geopolitical tension escalated. Big tech earnings cracked. Liquidity thinned. And when the first stops triggered, everything downstream followed. As analysts at Bitfinex and Schwab put it, this wasn't a sentiment event. It was a deleveraging event. The market wasn't asking questions. It was pulling plugs. So where does this leave us now? Short term, risk is still elevated. Futures open interest has come down roughly 20%, which is healthy, but not yet washed out. If leverage continues to drain and inflows stabilize, this kind of purge often becomes the base for the next move higher. If another macro shock hits, tariffs, jobs data, or geopolitical escalation, there is still room for another $1 billion to get flushed. Longer term, though, this matters. Events like this remove weak hands, reset funding, and clear distorted positioning. They are painful, but historically, they're how durable rallies begin. So here's the real takeaway. The market didn't die, it sobered up, and sobriety, while uncomfortable, is how cycles survive. When we come back, we're shifting gears, because while markets were bleeding, Washington was busy adding gasoline to the regulatory fire. That's coming up after this.
She redefined what it meant to race without limits. She proved that silence could be louder than words. Fearless, fast, focused. A reminder that champions are built on grit. That same intensity now fuels her signature blend. Roosted and roasted. Bold Italian roast crafted with the spirit of champions. Ashley's Roosted and Roasted, only at wholeshotcoffee.com.
And welcome back. So, while markets were busy liquidating leverage and digesting pain, Washington was busy doing what Washington does best, adding uncertainty. Because behind the scenes, a high-stakes fight has been unfolding between crypto and the banking system, and the White House just put a deadline on it. Let's break it down. Who's involved? At the center is the White House itself, with so-called crypto czar David Sachs attempting to broker talks. On one side, Coinbase, led by Brian Armstrong and much of the crypto industry. On the other, traditional banking interests, including major lobbying groups like the American Bankers Association, with quiet backing from Wall Street. In Congress, Senate figures like Tim Scott hover in the background, while Ripple's Brad Garlinghouse remains cautiously supportive of regulatory clarity, even as tensions rise. This isn't a small disagreement. This is a structural fight over who gets to control money-like products in the next financial cycle. So what's the fight actually about? Stablecoins, specifically yield. The White House has set a late February deadline to resolve a clash over proposed rules that would ban idle yield on stablecoins, while still allowing activity-based rewards like staking or transaction incentives. Translation? Banks want stablecoins to look more like checking accounts. Low yield, high control, heavy regulation. Coinbase argues this is dangerous. They say it tilts the field toward incumbents, kills innovation, and locks crypto firms out of competing fairly in what could become a $6.5 trillion market. And that's not hype. That number reflects the potential scale of stablecoins if they're allowed to function as modern financial instruments instead of neutered bank products. When did this escalate? Talks intensified in late January, around January 28th, when the White House made it clear this fight gets resolved by the end of February or it doesn't. Since then, Clarity Act markups have stalled, amendments are stuck, and uncertainty has only grown into early February. Markets hate that. Where is this happening? Officially, Washington, D.C., White House offices, Senate meeting rooms, closed-door negotiations. Unofficially, San Francisco, where Coinbase operates, New York, where banking power is concentrated, and globally, where developers, issuers, and capital are watching closely to see whether the U.S. is about to lead or fall behind. Why does this matter so much? Because banks see yield-bearing stablecoins as direct competition. A digital dollar that earns interest without traditional banking rails threatens their model. Coinbase's argument is simple. You don't regulate innovation by protecting incumbents. They warn that banning idle yields while favoring bank-style structures creates a system that's worse than no clarity at all. And that's the real fear here. Not regulation, but bad regulation. Markets can price clarity. They can't price confusion. So, where does this go from here? Best case scenario, a compromise. Limited yield structures approved, clear definitions written into clarity, stablecoin rules pass in Q1. If that happens, expect stablecoins, payment tokens, and select alts to rally sharply. 20% or more isn't unrealistic. Worst case, no agreement. Lobbying drags this fight toward midterms, regulatory limbo continues, and uncertainty becomes a permanent feature of the market. In off-road terms, this is a pit stop. If it goes right, the path clears. If it goes wrong, you're stuck in the mud while others keep moving. When we come back, we'll look at the rare exception, the asset that didn't bleed in this environment. Stay with us.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
Welcome back, everyone. Now, after liquidations, policy fights, and macro pressure that made everything feel heavy, something did the opposite. While Bitcoin slid, alts bled, and leverage got punished, Hyperliquid ripped. Let's talk about it. Who's behind this move? The Hyperliquid team, a decentralized exchange group building on their own chain. Not a VC circus, not a meme launch, actual product builders. The move was driven by active traders on the platform, long-term hype holders, and DeFi users looking for something that works when the rest of the market doesn't. Analysts from CoinDesk, Femex, Santiment, and CryptoSlate all flagged the same thing. This wasn't random. So what actually happened? Hyperliquid's hype token surged more than 71% over roughly 2 weeks. At peak, it was up double digits in a single day, trading in the $35 to $37 range. For context, this happened while trillions of dollars were evaporating from global risk markets. Bitcoin, down. XRP, struggling. Most alts, non-functional. Hype, outperforming everything, briefly pushing top 10 market cap territory in the middle of a bear tape. When did this kick off? Momentum started building around January 19th, but the real ignition came February 2nd and 3rd. That's when HIP4 rolled out, Hyperliquid's new outcome platform. And that's the key. Where is this happening? Entirely on-chain. No centralized exchange games. No offshore leverage roulette. The activity is happening directly on Hyperliquid's platform, with strong participation from DeFi-heavy regions, Asia and the US especially. Social buzz exploded on X, but the on-chain data backed it up. This wasn't vibes. Why did this work when everything else failed? Because Hyperliquid solved the exact problem that just wrecked the market. Leverage. HIP4 introduced prediction markets and options that are fully collateralized. No margin calls, no liquidation cascades, no domino effect. If you want exposure, you post full collateral, period. That changes trader behavior. Santiment flagged a surge in on-chain activity. CryptoSlate called it a bear market haven. Revenue tells the same story, around $4.3 million daily, with roughly $70 billion in weekly volume flowing through the system. This wasn't speculation. This was usage. So where does this go from here? If adoption holds and TVL continues climbing, targets in the $40 to $50 range are realistic, especially if traders keep rotating out of leverage-heavy venues and into platforms that don't nuke accounts during volatility. That said, macro still matters. Tariffs, rates, and geopolitical noise can cap upside short-term. But the signal is clear. While most of the market is still fighting the last cycle's battles, Hyperliquid is building for the next one. When we come back, we'll talk about another corner of crypto under real pressure, Bitcoin mining itself. Going into full detail after this.
Monday morning starts here, coffee in hand, ready for the grind. Leaving the bike behind, chasing the week ahead. Fueled by the passion to ride and the coffee that gets us there. Whole Shot Coffee. Fuel your life.
And we're back. Okay, if the last segment was about who's building forward, this one is about who's under real pressure. Because beneath the price action, beneath the liquidations, beneath the policy noise, Bitcoin's backbone is hurting. Let's talk mining. So, who's feeling this first? Bitcoin miners. Large operations, Foundry USA, Luxor-linked pools, and US-based firms in particular are taking the brunt. Analysts from CryptoSlate, Hashrate Index, and CryptoQuant have all flagged the same issue. Profitability is collapsing. Sean Rose at CryptoQuant notes that roughly 44% of Bitcoin supply is now underwater, and miners feel that faster than anyone. So what's actually happening? Bitcoin's mining difficulty is set to drop by roughly 14 to 18% this weekend. That's not normal. Difficulty is designed to adjust gradually, but right now, block times have spiked to nearly 20 minutes, double the 10-minute target. Daily miner revenue down to about $28 million, a 14-month low. This is a profitability crisis. When did this accelerate? The pressure built in late January and intensified into early February. Storms knocked hash rate offline, prices rolled over, and the post-halving math finally caught up. The difficulty adjustment is expected between February 8th and 10th, and it's one of the largest downward moves we've seen in years. Where is this hitting hardest? The United States, Texas in particular. An Arctic storm knocked roughly 110 exahash offline at peak disruption. But this isn't isolated. The entire global network feels it, from North America to remnants of Asia-based operations still operating in gray zones. Bitcoin is global. So is the stress. Why is this happening? It's a convergence problem. Post-halving rewards cut income in half. Price failed to hold momentum. Difficulty stayed elevated, peaking near 150 trillion last year. Then add high energy costs, weather disruptions, and thin margins. CryptoQuant's wording is blunt. Miners are extremely underpaid at current prices, and miners can't wait forever. So where does this go next? Short term, a difficulty drop offers some relief. Lower difficulty means better margins, if price stabilizes. Historically, major difficulty drops often coincide with local bottoms, but the risk remains. If prices stay depressed and storms or costs persist, we could see minor capitulation, forced selling, shutdowns, and further stress on the network. Longer term, many miners are hedging their future, shifting toward AI compute, high-performance data workloads, and diversification beyond pure Bitcoin. Watch the hash rate closely. A recovery above 966 exahash would signal stabilization. And that brings us to the real point. This market isn't just emotional, it's mechanical, and right now, the machines are telling a story. When we come back, we're going to lighten the mood, check the temperature of the community, and I get to do what I do best. Proof of Thought Mailbag is up next. Stay with us.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, before we wrap this thing up, let's do what the market clearly refuses to do. Breathe. It's time for the Proof of Thought Mailbag, where conviction meets confusion, and usernames tell us everything we need to know. Let's get into it. Submission number 1 is from @diamondhands_actual_final_V7 and reads, still holding, haven't sold anything since 2021. Everyone panicking just doesn't get Bitcoin. First of all, respectfully, your username tells me this is not your first final form. Second, you might be right, but there's a difference between conviction and emotional numbness. Holding through volatility is a strategy. Refusing to update beliefs is a personality trait. Bitcoin doesn't care how long you've been holding. It only cares if the network keeps working. Next one is from @liquidated_but_learning and asks, got wiped at 20 times, thought this was the bounce. Guess not. What am I missing? You're missing one thing. Time. And maybe a little self-control. Look, the market didn't target you personally. It just noticed leverage and did what it always does. 20x in a macro downtrend isn't bravery. It's donating liquidity to someone smarter, or at least more patient. The lesson hurts, but it's cheaper than repeating it. Okay, this next one from @whyishypegreen asks, everything I own is red except Hyperliquid. Am I late or early? Ah, yes, the most dangerous question in crypto. Why is that green? Here's the answer. It's green because it solved the exact problem that just wrecked your portfolio. No forced liquidations, no leverage roulette, actual usage. Are you early? That depends. Are you chasing candles or understanding why they exist? Big difference. @RegulateMeDaddy asks, if clarity passes but bans yield, is that actually good? First of all, terrible handle. Second, excellent question. Clarity that kills innovation isn't clarity. It's permissioned stagnation. Markets don't need protection. They need rules that don't pick winners in advance. If the rules favor incumbents, capital leaves. History has receipts. Okay, last one for today is from @ASIC&Anxiety and says, mining feels cooked. Difficulty, storms, halving. Is this the end? No, but it is the stress test. Mining has always gone through this phase. Weak operators exit, strong ones adapt, and the network keeps producing blocks. Pain doesn't mean failure. It means selection. And Bitcoin is very good at selecting. Here's the through line today. Markets punish excess. They reward structure. And they don't care how confident you sound on X. If you're still thinking, still learning, still asking better questions, you're doing fine. And if you want your comment featured in a future mailbag, you already know what to do. Stay curious. Stay solvent. We'll be right back.
Our beans are washed in ancient waters, filtered through coal seams deep beneath the Utah mountains. Okay, not really. We totally made that up. But it does sound badass, doesn't it? Here's the truth. Premium Guatemalan beans, aged for 30 days in real whiskey barrels, then carefully roasted smooth in the golden light of California, inspired by the legendary Drunkard's Wash Desert Race in Price, Utah. Bold, smooth, with a subtle touch of whiskey and oak. Drunkard's Wash. Whiskey barrel aged, bold and unmistakable. From Whole Shot Coffee Company. Fuel your life.
All right, let's land this. Today wasn't about predicting the bottom. It wasn't about calling the next pump. And it definitely wasn't about pretending this week didn't hurt. What we saw was something simpler and more important. Markets don't break when prices fall. They break when structure fails. And this week, Structure got tested. Leverage failed. Liquidity failed. Narratives failed. But the system itself, still running. Blocks are still being mined. Protocols are still shipping. Builders are still building. Sometimes quietly, sometimes while everyone else is yelling. Pain doesn't mean the thesis is wrong. It means excess was present, and excess always gets corrected. That's not bearish. That's how systems survive. If you're feeling shaken, zoom out. If you're feeling confident, stay humble. And if you're still here, still thinking, still learning, still solvent, you're already ahead of most participants. We don't do panic here. We don't do false certainty either. We do context, we do signal, we do patience. I'm SENB Hero. That's it for today, and I'll see you next time. The SENB Daily Brief is a production of SENB Hero Media in collaboration with Whole Shot Coffee, coffee that fuels champion. Written and hosted by yours truly, SENB Hero. Production, editing, and scheduling handled by Maya Valencia, who somehow keeps me on time, caffeinated, and occasionally polite. Original theme music composed and produced by Paul Hahn, the community legend whose beats hit harder than a Fed rate hike. Research support provided by the SENB community. Proof that sarcasm and spreadsheets can coexist. For more shows, merch, and on-chain chaos, visit senbheromedia.com. Thanks for tuning in. Stay caffeinated. And remember, if it's not in the brief, it probably wasn't bullish anyway.
Set my wallet free.